Every single month, thousands of rental property investors discover they're actually losing money. They look at their bank account and see a positive number. They think they're winning. They're not. They never ran the numbers correctly. By the end of this video, you will know exactly how to calculate cash flow on any rental property, and you will never make that mistake again. I'm going to walk you through 3 methods. The third one is the one most YouTube videos skip entirely. It is the difference between a property that builds your wealth and one that slowly drains it. So, sit back, pour yourself something. Let's get into it. Here is the first thing you need to understand. Cash flow is not rent minus mortgage. That is a dangerous oversimplification that has hurt more first-time investors than almost anything else in real estate. Cash flow is the actual money that lands in your pocket after every single expense is accounted for. And most people miss half of those expenses on their first calculation. Let's fix that right now. The first method is the gross cash flow check. This is what you do in the first 60 seconds of looking at a deal. You take the monthly rent. You subtract your mortgage payment. You subtract what you estimate for property taxes and insurance, and you get a number. This is a rough sanity check. Nothing more. Here is why this matters. If this number is negative, you can often fix it by adjusting one variable, the purchase price. Negotiate harder. Ask for seller concessions. Find a different financing structure. But you need this number to be at least in the ballpark before you move forward. Let me give you a real example. My friend Marcus looked at a property in Memphis listed at $185,000. The rent was $1,650 a month. His mortgage with 20% down at 7% interest came to about $990. Property taxes were $2,200 a year. Insurance was $1,100 a year. Do the math in your head right now. Marcus got a cash-on-cash return of about 8% on this deal. That was his gross check. He was in the game. Now here is where most people stop. They see a positive number and they celebrate. I get it. You found a deal. But you are not done. Not even close. The second method is the net operating income calculation, and this is where the real picture starts to emerge. Net operating income, or NOI, is your gross rental income minus all operating expenses. Not debt service, not your personal financing, just the cost of running the property. This is the number that tells you what the building itself is producing as a business. Here is exactly what goes into operating expenses: property taxes, insurance, property management, even if you plan to self-manage, maintenance reserves, vacancy allowance, HOA fees if applicable, utilities if you pay any of them, legal and accounting fees. And here is the one most people forget: capital expenditure reserves. The roof will need replacing. The HVAC will die. The water heater will go. These are not monthly maintenance costs. These are big dollar items that happen every 5 to 15 years, and you need to be setting money aside for them right now. The standard rule of thumb is the 50% rule. Half of your rental income goes to operating expenses before you touch debt service. This is not a perfect number. In some markets, it is 40%. In others, it is 60%. But it is the most useful shortcut in real estate investing, and it will save you from making terrible decisions. Back to Marcus. His $1,650 a month rent is $19,800 a year. The 50% rule says his operating expenses should be around $9,900. His actual operating expenses that first year were $8,400. His NOI was $11,400. That is a healthy number. That is the number that told him the building itself was a good business, separate from how he financed it. Now, before we move to the third method, I want to make sure you are getting value here. If this is clicking for you, hit subscribe. I drop videos like this every single week. And the third method coming up is the one most investors never learn. Stick around. All right, here it is. This is the one I have been saving. The third method is the full cash flow calculation, and it includes something called the debt coverage ratio, or DCR. This is the number lenders look at. This is the number that tells you whether the property can actually service its own debt. And once you see how to calculate it, you will immediately spot which deals are winners and which ones are traps dressed up as opportunities. Here is the formula. Net operating income divided by your annual debt service. Debt service is your total mortgage payments over an entire year. Marcus's NOI was $11,400. His annual mortgage payments were $11,880. So his DCR was 0.96. Let that number sink in for a second. Below 1.0 means the property is not generating enough income to cover its own mortgage. Marcus was technically cash flow negative on a DCR basis. But here is why the story did not end there for him. He had a 2-year plan. He was buying under market value. He was counting on appreciation. And he was right. 2 years later, rents in that neighborhood went up 12%. His NOI climbed to $13,200. His DCR crossed 1.1, and the property appraised at $218,000. He refinanced, pulled out his original down payment, and now owns the building with none of his own cash in it. That is the power of understanding cash flow at every level. Not just the surface number, the deep number. Now I want to give you the full formula you can use on any property tonight before you sign anything. Step 1, list all rental income. Include laundry, parking, any side income from the property. Step 2, apply a vacancy rate. The national average is 5 to 7%. In high demand areas, it can be 2%. In volatile markets, it can be 10. Step 3, calculate your effective gross income by subtracting vacancy from total income. Step 4, subtract all operating expenses using the 50% rule or actual numbers if you have them. That gives you NOI. Step 5, subtract your annual debt service from NOI. That gives you your true annual cash flow. Step 6, divide annual cash flow by 12. That is your monthly cash flow. That is the number that matters. Let me walk through one more example from scratch so this is crystal clear. Say you find a property for $240,000. You put down 25%. That is $60,000. Your loan amount is $180,000 at 7.5% interest on a 30-year fixed mortgage. Your monthly payment is about $1,258. Monthly rent is $2,100. Your property taxes are $3,600 a year. Insurance is $1,440 a year. Property management is 10% of rent, which is $210 a month. Do the calculation. Gross income, $2,100. Subtract vacancy at 5%, $105. Effective gross income, $1,995. Subtract operating expenses, $1,260 for management, $300 for taxes, $120 for insurance. Total operating expenses, $1,680. Your NOI is $315. Subtract your mortgage payment of $1,258. Your annual cash flow is negative $943. Monthly cash flow is negative $79. Walk away? Not necessarily. This is where your negotiation skills matter. What if you got the price down to $205,000? Your mortgage drops to $1,075. Now your annual cash flow turns positive. You are making $69 a month. It is not glamorous, but now you have a foot in the door in a market where you believe rents will rise. That is the game. Cash flow calculation is not about finding a perfect number. It is about knowing exactly where you stand so you can make the decision that makes sense for your goals. So here is what you do this week. Pull up a spreadsheet, plug in these 5 steps, run them on 3 properties you are considering, compare the numbers side by side. The property with the best cash flow on paper is not always the best deal, but the property you can analyze correctly is always the one where you will not get surprised. If this video helped you, share it with someone who is looking at their first rental property. Hit like if you want more content like this. And subscribe. I have a whole series coming on real estate investing, including how to analyze a market before you ever look at a specific property. That one is going to be a game changer. See you in the next one.